Okay guys, next chapter is accounting for material. We don't necessarily talk about accounting double entries for material. Like in previous chapter, we didn't necessarily talk about double entry for labor. So here we will discuss issues relating to material, important things relating to material. So one of the things relating to material is documents. You would have already studied this in F3, so I assume if you are coming to F2, you should already have some information about these documents. What I'm going to do here is just quickly skim through these documents and then explain other topics as well. So the first thing is documents used when we purchase material. So I've made a system here. Systems in every organization are different depending on the size of the organization. Usually, the bigger the organization, the more documents they have, the more steps they have. The smaller an organization, the less documents they will have, and the less complicated the system is going to be. So, the purpose of this specific chart is not to explain purchasing system, but to explain purpose of some of the documents we have here. So what I've done here is design a system of how usually things are purchased within an organization. So the first thing we have is production department. Production department needs material. When it runs out of material, it will prepare this document. If organization is smaller, then material will be within production department. As I said, when organizations are bigger, usually they have many departments and the work is divided. So production department will only produce things, factory. So when they run out of material, they prepare this document called material requisition note. So requisition simply means request. So in material requisition note, what the production department is doing is requesting material from store or warehouse. Store or warehouse is where the material is kept. So material requisition note is a specific document. If we remove the word material, just requisition note would be a document that is used to ask anything from any department. So if something exists in another department, let's say there's a printer, you're working in sales department, there is an extra printer in finance department, you are requesting that, you will do that through requisition note. So material requisition notes are specific and requisition notes are general. If store has material, then they will transfer it using transfer note. So material transfer note is document used to evidence transfer of material. You don't have to remember definitions, just understand the concept of these documents. So just like material requisition note, material transfer note is also specific. If you remove the word material, then transfer note would be a document used to evidence transfer of something from one department to another department. Now if store has the material and they transfer it, then it finishes. But obviously, let's say store doesn't have material. Now store only has responsibility for keeping material, handling material. They don't have responsibility or authority to purchase material. In smaller organizations, they might have authority, but as I explained, the bigger the organization, the narrow the duties. So they prepare a document called purchase requisition note. They send it to procurement or purchasing department. Now procurement or purchasing department is a department specific for purchasing things. They have expert people working in that department. They have knowledge of the prices. They have knowledge of the suppliers. So all the things you want to know about purchases, they have it. So When purchase requisition note is made, usually a copy of material requisition note would be attached with it to prove that it is actually requested by production department and it is something that is needed. So when authorization is there, then procurement department will start a procedure. One of the things that they would do is ask supplier to send quotations. They will prepare a document called request for quotation or RFQ, and they will send it to many suppliers. So the more the suppliers there, the more will be RFQs. Maybe they send it through email, maybe they physically do it, but physically will not be very popular these days. Some organizations advertise this RFQ on their website. So suppliers regularly check the websites of the customers, and then they see if there is a RFQ there, they will send quotations. Remember, purchasing department is sending it to the sales department because if one person is buying, another person is selling. So we have this kind of mirror image situation. So supplier sales department prepares quotations or estimates. Quotation and estimates are very similar and they usually mean the same thing, but there is a slight difference. Quotation is usually fixed and usually prices that are per unit. An estimate is not fixed. It is as it means estimate, which means estimate of the total cost. Estimate would be used, for example, where a service or product is not 100% confirmed. There could be some variations. So the best an organization could do is send an estimate. Example of this would be with a construction company, for example. Okay, so purchasing department will receive quotations, and the quotations that they receive will depend on how many suppliers they have been found and how many suppliers are interested in doing business with them. It is just like when you advertise for a job. So the people that apply would be availability, depend on availability and their interest in doing job with your organization. Then the purchasing department chooses between these quotations. And they usually go for the lower price. Obviously, in non-profit organization, the first criteria is that it should have a lower price. If you don't award a contract to an organization that has the lowest price, you need to justify that. So the first thing they will look at price, and then obviously that price has to be justified with the quality. So whatever the purchasing department is looking at, they will decide and choose one quotation. Then they will prepare purchase order, shortly known as PO. They will send it to the sales department. Now remember, we have purchase order and sales order. Purchase order and sales order are the same thing. The perspectives are different. Like this purchase order for supplier becomes sales order because they are selling. For buyer, it becomes purchase order. So in accounting, most of the time, what is something for one party could be something else for another party. So for supplier, it will be purchase order when they are buying something. And usually, whichever department prepares the document, they will title it according to their perspective. Because purchasing department is making this document, they will call it purchase department. If supplier was making this document, for example, the purchasing department calls supplier to prepare an order and send a copy to them, then the supplier would call it sales order. So according to the exam, according to book, purchase order is request when we are buying something, and sales order is request from customer when we are selling something. But in fact, in reality, they are same thing, two sides of the same coin. Now, supplier will send, sales department will send a copy to the warehouse, which will make it ready for dispatch, depending on delivery. And when goods are delivered, the person who is delivering the goods will have this document called Goods Delivery Note, or GDN. It will be delivered to the store. Remember, purchases are made by the purchasing department, sent to the sales department, but dispatch is made from the warehouse to warehouse. Delivery will not be made to the purchasing department. Obviously, in small organizations, it will be same building, but in big organizations, maybe these departments are in very different locations. Whenever this purchase order is made, there will be a copy of, there will be two things written, bill to address and ship to address. Bill to address is address of the purchasing department, address of the store, finance, and ship to address is the address of the store. And when a purchase order is made, sent to the supplier, the main copy is sent to the sales department, but one copy will be sent to the finance department as well. Because finance department will be receiving bills, so they need to know that it is something that they have purchased, and one copy will be sent to the store as well, to let them know that we have ordered something and they are expected to receive it. So when delivery is made by the supplier, they will have a document, they will give it to the storekeeper, and they will sign it and give it back. Now, storekeeper will prepare his own document called Goods Received Note. One copy will be sent to the purchasing department to let them know that goods have been received. One copy will be sent to the production department to let them know that goods have been received and they will be delivered to them. One copy will be sent to the finance department because finance department will be making payment. And after some time, we will receive a bill from the supplier, bill or invoice, stating the amount that needs to be paid and the time that needs to be paid. And when finance department sees that all the things are there, there is purchase order, there is goods received note, there is invoice, and then they look at the time, usually before due date, they will make payment, and they will use a document called remittance advice. So in remittance advice, the attached payment, if it is a check, for example, a check would be attached with it and detailing the reason for payment. But nowadays, it would be more like an email. When a transfer is made to the supplier, an email would be written showing the details of the transfer and then stating the reason for that transfer. So I've written the definition of these documents here as well, if you want to know. Otherwise, let's move forward. Okay, next, we have cost associated with material. Whenever we are buying material, there are costs associated with it. They are divided in 4 categories: purchasing, ordering, holding, and stockout. So purchase is costs relating to purchasing material, usually the purchase price, and every other cost relating to purchase. It could be customs, delivery, and all that stuff. And then you have ordering cost. In ordering cost, you could have delivery as well. You could have documentations. And then we have holding and stockout. Holding cost would be the rent that you're paying for material. They could get damaged if you have them in inventory. They could be stolen. They could become out of date. They could become expire. Stockout arises when you don't have inventory. Not having enough inventory means you run out of inventory. It also has cost. One is the opportunity cost. Opportunity cost is the benefit foregone from not utilizing an opportunity. There is opportunity presented to you and you don't utilize that opportunity. The opportunity is a customer comes asking for a product and you don't have that product. If you had the product, you would have sold it, you would have made profit. But you didn't have product, you didn't utilize the opportunity, so you didn't make profit. And also the biggest disadvantage, the biggest cost that stockout has is goodwill. It affects reputation of the business. If you go to a store, especially if you travel and the store is at a very big distance, you go there once and you want to buy something, they don't have it. Maybe next time you go, you don't go there. So in your mind, there's a doubt that maybe the store would not have what you're looking for. So that's why these big superstores, they usually have things that customers don't buy regularly as well, because they want customer to have this idea that whenever they go to a certain store, they will have everything that they need. Okay, so the purpose of inventory control would be to make these costs as low as possible, trying to make all of these costs lower. Remember, if you want to save cost, it is better to look at many things. If you just focus on one aspect, for example, purchasing or ordering or holding or stockout, it will be very difficult to reduce cost. But instead, if we focus on all aspects, then it will be easier to reduce costs. So one thing that will help us reduce these costs is economic order quantity. Economic order quantity helps us reduce the cost of ordering and holding. It doesn't guarantee the purchase price or stock out. It guarantees that the holding cost and ordering cost will be reduced. Economic order quantity. What is order quantity? Order quantity is the units that we buy at a time. For example, we need 12,000 units every year. If we buy 1,000 units every time we buy, then that is order quantity. If we buy 2,000 units every time we buy, that is order quantity. So when we need 12,000 units, for example, should we buy 12,000 units at once? If we buy all of them at once, what happens is the ordering cost reduces because of the economy of scale in ordering. Maybe we need one car in which all the things are fit, and documentation and stuff would be reduced. So it will be easier. So the ordering cost would be reduced. But the problem is when you have to keep that in the business. If you keep that in the business, then the holding cost will increase, the rent will increase, you will run out of space, damage will increase, theft will increase, it will become obsolete. A good example of this I will tell you is when you are buying groceries for your house. The monthly ration that you need, maybe you buy the whole thing at once. The problem with that is you buy some of the things that you don't regularly need, and then they could be damaged, especially if they're vegetables. And then that whole thing you have to store in your fridge, so there might not be enough space. So the holding cost could increase. Now if you buy lower quantity every time, let's say we buy 1,000 units every time that we buy, then the holding cost will reduce, but the ordering cost will increase because we have to buy 12 times. So there is this problem. They are inversely related. Remember, I previously explained what is a relation and what is directly related and what is inversely related. Inversely related means when one thing increases, another thing decreases. Directly related, when one thing increases, another thing increases with it. So cost of holding and cost of ordering are inversely related. If you want to reduce the cost of holding, your cost of ordering increases. If you want to decrease the cost of ordering, your cost of holding reduces. If you want to order more quantities to save on ordering cost, holding cost will increase. If you want to order less quantities to save on holding costs, order quantities will increase. So economic order quantity believes that cost will be reduced when cost of holding and cost of ordering are equal. I will explain that when we work on a question. But economic means less costly order quantity, the quantity that we order. So economic order quantity gives us the quantity that we need to order. So the question that it answers, the question that economic order quantity answers is how much to order at a time. If you want to buy quantities at a time, how many units should we buy at a time? Hence economic order quantity. So it answers the question of order quantity. There is a formula for it. And this formula is given to you in exam. This comes in other topics as well. It comes in F5 as well. It comes in F9 as well. Wherever it comes, the formula is always given. So you don't have to remember the formula. So economic order quantity, or EOQ, is 2COD divided by CH. What is CO? Cost per order. D is demand. Demand, annual demand. If it is not annual demand, you have to convert it to annual. So things here have to be annual. CH is the cost of holding per unit per annum. If cost of holding is not given per annum, you have to convert it to per annum. So demand and holding cost, both of them need to be per annum. Cost of order obviously will be per order. Otherwise, demand and CH is per annum. So you need three things: cost per order, cost of holding per unit per annum, and demand. Let's look at a question here. The annual demand for an item of inventory is 2,500 units. The cost of placing an order is 800, and the cost of holding an item in stock for 1 year is 15. What is the economic order quantity to nearest unit? Okay, in this example, the cost of placing an order is 80. Holding cost is 15. They are per year, and demand is 2,500 per year. So this is how you put it in your calculator. 2 multiplied by CO, which is 80, multiplied by demand, which is 2,500, divided by 15. So if you put it like this in your calculator, which I'm going to do now, you will have the quantity, economic order quantity. So 2 multiplied by 80, multiplied by 2,500, divided by 15. You have 163. So what you can do is, if you have bigger formulas, what you can do is divide things in parts. For example, what you could do is take 2 multiplied by 80, multiplied by 2,500. That gives you 400,000 divided by 15. It gives you 266 something. 26,666. And then you can put that in calculator. So my recommendation is do it in parts. So you have higher chance of answering it correctly. So equals 163. So what is 163? 163 means whenever we are placing an order, every time we should place order for 163 units. That means if we are buying 2,500 units and we place order for 163 units, we will be ordering 15 times. Let's move forward. We have another question. What is the economic order quantity? A company wishes to minimize its inventory cost. Order costs are 10 per order and holding costs are 0.10 per month. Falco estimates annual demand to be 5,400. What is the economic order quantity? Okay, first we have to find our ingredients. We have the CO, which is 10. We have the holding cost, which is 0.10. But remember, it is per month, so we have to multiply by 12 to convert it to year. Everything has to be in years. And then we have demand, which is 5,400. Okay, so economic order quantity would be 2 multiplied by CO multiplied by 5,400 divided by 1.20. If you do calculation in parts, 2 multiplied by 10 multiplied by 5,400 gives you 108,000. Dividing that by 1.20 gives you 90,000. And putting that in calculator gives you 300. So economic order quantity, the answer here is D. In the previous one, I didn't select the answer. It is C. So next, I want to prove whether economic order quantity gives us the lowest cost or not. Remember, economic order quantity gives guarantee of two costs, holding cost and ordering cost. It says that the holding cost and ordering cost will be reduced collectively, not individually. It says when you combine the holding cost and ordering cost together, it will be lower or equal. Sometimes it can be equal, but it will not be higher than any other quantity that you order. So for that, what I will do is find the total cost of holding per annum. To find the total cost of holding per annum, I need to find average inventory multiplied by cost of holding. So why do I need to find average inventory? I will explain in this previous graph. See, whenever we buy inventory, for example, 163, when we buy it on the first day, there will be 163 units. But we will be using them, we will be selling them so that inventory will reduce. If we are making, paying rent or any other costs relating to the holding, they will be usually counted per day. So on the first day, holding costs will be on the 163 units. On the second day, it will be on 150 units, for example, and they will reduce. And they will become near zero, and then we will order more. So it goes on like that. So in our warehouse, we will have about average inventory, sometimes more, sometimes less. So we cannot say that we will have holding costs on 163 units. We will have holding cost on 163 divided by 2, which is average. So it is not exact figure, but it is better than 163. So we need to find average inventory, which is ordering quantity divided by 2. In this case, ordering quantity is 300 divided by 2. We have 150 average inventory. Now take that, multiply by the holding cost, which is 1.20. So we have 180 TCH. And to find the total cost of ordering, we need to find total orders multiplied by CO. Orders is demand divided by ordering quantity. Our demand is 5,400. We ordered 300 units every time, so 18 orders. 18 orders multiplied by 10 becomes 180. Now the thing about economic order quantity is that your holding cost and ordering cost would be same. If your ordering and holding cost is not the same, it means maybe your calculation of economic order quantity is not correct, or maybe you have made some mistake here. But the thing is, holding costs and ordering costs should always be the same. I'll explain this in a graph. The reason it works is, let's look at a graph if we have here. Okay, I don't have it here, but it might come in kit questions. So I will explain here that why it is like this. So if we order 300 units, the ordering cost and holding cost collectively becomes 360. So what I've done is found costs for two other activities as well. other units as well. One for more than 300, another for less than 300. Let's make this 250 maybe. So let's see what will be the cost of 400 units if we order 400 units. So let's find TCH. You don't have to go through all these steps. You can just simply take 300 divided by 2 gives you average, multiply by 1.20, sorry, 400. Should give you 240. Obviously, because the quantity that we are ordering is more, the holding cost will be more. But then the ordering cost will reduce. 400 divided by 400 will give us orders, multiply by 10 gives us 135. So ordering cost has reduced, holding cost has increased. But the important thing is whether both of them collectively is more or less. If you see, it is 375 and EOQ was 360. Let's look at 250 units. If we order 250 units at a time, then it is 250 divided by 20. Obviously, holding cost will be less here, becomes 150, and then taking that, finding the ordering cost is 216. So 375 plus 216 equals 591. Have I done it correctly? Sorry, 150. 150 plus 216 becomes 366. It's still higher than 360. So no matter whatever the quantity that there is, it will not give you lower cost than the EOQ. It can give you equal cost, but it will not give you lower cost than EOQ. So we saw that whenever there is no change in purchase or any other price, EOQ always gives you the lowest cost. But sometimes we are given a discount. Like we look at a question here, a company uses an item of inventory as follows. We have purchase price, annual demand, ordering, annual holding, EOQ. What is the minimum total cost assuming a discount of 2% applies to purchase price and to holding costs on orders of 300 and over? So our EOQ says buy 160 units, but the supplier says if you buy 300 units at a time, I will give you 2% discount. So in a situation like this, we have to compare. If there is no change in the price, obviously EOQ always gives you the right answer, the lowest cost. But whenever there is a change in purchase price or whatever, then we have to compare. Even though EOQ is given, but just for practice, I will calculate it again. So we have 32 multiplied by 1800 divided by CH 4.50. So that becomes 2 multiplied by 32 multiplied by 1800 divided by 4.5 becomes 25,600. And that put in calculator becomes 160 what they wrote above. Okay, so we have to compare whether 160 gives us the lowest cost or 300. So let's first look at 160. Let's look at TCH. TCH would be 160 divided by 2 average cost multiplied by 4.50. TCO is 1800 units divided by 160 multiplied by 32. And then we have to look at purchase price as well here. Normally we don't look at purchase price, but in this case, because the purchase price is changing, we are looking at purchase price as well. So total 3 costs according to EOQ is 360 plus 45,000 becomes 45,720. If we order 300 units or more, then we have 300 units divided by 2. But remember, they said 2% discount applies to purchase price and holding cost. So that means I have to multiply this by 98%, because 100% minus 2% becomes 98%. So 661, obviously holding cost will be higher. And then we have ordering cost. Ordering cost will be lower, 192. And there is a discount on purchase price as well. So I have to multiply by 98%, which means 44,100. Now if I add all three costs together, that's 44,100. We have 44,953, which is lower than 45,000 here. So even though EOQ saves on holding costs and ordering costs, but in this specific scenario, the lower cost is with buying 300 because there is discount. If there were no discount, without doubt, EOQ would give us the lowest cost. So we should always go with EOQ. But if there is a change in purchase price or another cost because of quantity, then we have to compare and see which gives us the lowest cost. Okay, this was answering the question, how much to order at a time. That is economic order quantity. So economic, we saw that we should always go with economic order quantity, but if there is any change in purchase price or any other cost because of quantity, then we have to compare. Next is when to order. That is reorder level. So remember in exam or in question they said to avoid stockout. We want to avoid stockout. We don't want to run out of inventory before next order arrives. So there is a formula you need to learn, which is the order level equals maximum demand multiplied by maximum lead time. But there is a sense behind it. You don't just have to memorize it. Now, why does stockout happen usually? Why does an organization run out of inventory? If they have order on the right time. They have order on the right time. There's no problem in them ordering late. They have order at right time, but they still run out of inventory. What could be the two reasons? One reason is demand is more than expected. When company placed order, the demand was the highest, because of which, before the new order came, the previous one was consumed. The second reason is, even though order was made on time, the delivery came late. They took the longest that it could take. So even if we sell the highest quantity, even if demand comes very late, we should still have inventory until the last day. So that's why the reorder level is maximum demand multiplied by maximum lead time. So we have a question here based on data above, at what inventory level should replenishment order be placed, which means what is reorder level. A domestic appliance retailer with multiple outlets sells a popular toaster known as Order Crisp 2000, for which the following information is available, with average sales, maximum sales, minimum sales, and lead time. And reorder quantity, which can be EOQ or whatever quantity it is. So reorder level is maximum time multiplied by maximum usage. So maximum usage is 95, maximum time is 18. 95 and 18. So we have 17, 50, 10 reorder level. What it means is that when our inventory reduces to this level, we should order more. How much more? Order quantity, which is 1750. So where our inventory reduces to 1710, we will place an order for 1750. So then we will not have stock out, even if the maximum quantity is sold, even if order arrives late. So this is reorder level. Next is maximal level. How much is too much inventory? Obviously, we have to think about stockout. We have to think about the costs relating to stockout, but it doesn't mean we should have as much inventory in our warehouse as possible. There still is too much inventory, so that is maximum inventory level. So this is the high level that inventory should not cross. The formula is reorder level, let me write here, maximum level equals reorder level minus minimum demand multiplied by minimum time plus OQ. In book they have written it like this: reorder level plus ordering quantity minus minimum demand into minimum time, which means the same thing. But this way it makes sense. This formula makes sense as well. See, if I go to warehouse and I see there is too much inventory, what are the two reasons that the supplier could give me? The storekeeper could give me, because he's responsible for material handling and for the quantity of material. So two reasons he will give me is we sold the lowest quantity, so the sales department was not able to sell as much. The second reason he will give me is the order came very early. We placed order and it came in the earliest time. So both quantity was sold less and order was arrived early, because of which we have this quantity. So I say, okay, we place order for 1750, which is here, at 1710. So when 1710 happens, we place an order. So we sold minimum at minimum time. The lowest quantity was sold in the lowest time when the new order came. So inventory should not be more than this. So reorder level was 1710. We used minimum, which in this case is 50, and minimum time is 12. So we use 50 multiplied by 12. So which means our inventory was 1110 when the new quantity came. The new quantity is 1750. So it gives us answer of 2860. So inventory should not be more than 2860. If it is more than this, there is no reason to justify it. So it would mean mismanagement of inventory. Obviously, whenever there is a maximum limit, there will be minimum limit as well usually. So minimum level is the lower level the inventory should not decrease to. Obviously, 0 is not a minimum. Before inventory becomes 0, we need to do something about it. We need to avoid stockout. If inventory becomes 0 and then you're worrying about it, it is not a good strategy. So before it becomes 0, we should have alternative. So if it decreases from this minimum level, what we will do is we will find contingencies. Maybe another supplier, local supplier, which is charging higher price, but because stockout cost has a very huge effect on our goodwill, we would usually arrange with alternative supplier. So the formula for minimum level is reorder level minus average use multiplied by average time. So the way to remember it is we use maximum. If I use maximum usage at maximum time, the answer would be 0. See, if I write here, reorder level is 1710. Maximum usage was 95. Maximum time was 12. Was it 95? Maximum use is 95, 18, sorry. Usage is 95, but maximum time is 18. So what it does is it gives me 0. So obviously 0 would not be the answer. If I use minimum here, which was 50 and 12, which is 1110. 1110 is not a minimum level because it usually leads to overstocking rather than understocking. So what we have left is average. So when it becomes about the middle, we should start worrying about it. So average usage is given, but average days are not given. When average is not given, you have to calculate it. But if it is given, don't calculate it, okay? Otherwise, your answer would be wrong. So if it is not given, I will calculate it. So 15 days average, and average sales is 75. 75 multiplied by 15 becomes 585. So this is the level that inventory should not decrease from. If it does, it is a danger point, and we have to find contingencies. So we saw 4 things. How much to order at a time, which is order quantity, which in this case was 1750. Next was when to order, reorder level, which was 710 in this question. Next, maximum level, which was too much. And next, minimum level, which is too little. So if we put this on a graph here, our maximum level would be the higher red line, the minimum level would be the lower red line, and then 1710 would be the green signal to order more. If our inventory is in between these 2 red lines, it means we are managing our inventory good. But if it crosses the above red line frequently, it crosses the lower red line frequently, it means we are not managing inventory very well. Okay, before I explain this, I want to explain something called economic batch quantity. We had economic order quantity, which answers the question of how many units to order at a time. Next, we have economic batch quantity, or it is also known as economic production run. It answers the question of how many units to produce at a time. It is used in factories which are continuously producing. So they want to know how many units should they produce and then stop. Because usually there is a huge setup cost involved in factories. So they want to know the quantities that they need to produce, and after that they stop. Maybe they continuously work for 2 or 3 days. Maybe they continuously work for weeks. So economic production run or economic batch quantity gives us the total quantity that a factory should produce, and then it should stop production. The best way to explain this is to look at a question here. We have a question here. Required calculate economic production run. A company is able to manufacture its own component for inventory at the rate of 4,000 units per week. So we can produce 4,000 units per week. Demand for the component is at the rate of 2,000 weeks. Remember, demand should be lower than our production capacity. If demand is higher than our production capacity, then we shouldn't stop. We should continuously be producing. There shouldn't be any economic production run quantity. The idea is if our capacity is more than the demand, then we should produce a certain quantity, and after that quantity, we should stop production. Setup costs for each production run are 50. Every time we start factory, it costs $50. The cost of holding 1 unit of inventory is 0.01 a week. So let's look at the formula now. It is very similar to economic order quantity, a little bit difference. EBQ obviously is economic batch quantity. R is the rate of production per time period, which in this example was 4,000. Let me write that here. R equals 4,000. Q is the quantity produced each time. So Q is what we are finding, economic order quantity. D is the demand, which in this case was 2,000. Remember, this demand is weekly, but production is also weekly. It doesn't have to be yearly. But the important thing is everything has to be the same. If demand is weekly, production should be weekly, holding costs should be weekly. If they are monthly, everything should be monthly. So they should be consistent. So I've written here, debt should be consistent. So we have demand 2,000. Cost of order was in ordering quantity, it was cost of order, but here it is setup cost. And then we have cost of holding, which is the same as economic order quantity. So this is already given as per week. So everything, the rate, the demand, and the CH is per week. So the only thing you need to do is to put it in this formula. So we have 2 multiplied by CO, which is 50, multiplied by demand, which is 2,000, and then divide that by CH, which is 0.001, multiplied by 1 minus D, demand, which is 2,000, divided by R, rate of production, which is 4,000. Okay, so you can manage the brackets, but my recommendation, especially for EBQ, is do them separately in parts. So first I will do the top part, which is 2 multiplied by 50 multiplied by 2,000 becomes 20,000. So I write 20,000 here, top part, and the bottom one, start from left here. Start here. First take 2,000 divided by 4,000 becomes half, 0.50. If you take 0.50 and minus it from 1, how much does it give you? 0.50. So 0.001 multiplied by 0.50 becomes 0.005. Divided by 0.005. Now take 20,000 divided by 0.0005 becomes about 40 million. And then put that in formula here. So 1, 2, 3, 4, 5, 7. Okay, let me double check that. 2 multiplied by 50 multiplied by 2,000 demand becomes 200,000, sorry. It's not 20. 2 multiplied by 50 multiplied by 2,000 is 200,000. 200,000 divided by 0.005, about 40 million. 400 million. Now put this in calculator. What you can do is put these two in calculator together if you are worried about zeros. So I will do that as well. So 200,000 divided by 0.005 gives me 20,000. So 1, 2, 3, 4, 5, 6, 7. There are many zeros. It becomes 20,000. So the best thing to do is put these together so you don't miss zeros. So the zeros are 1, 2, 3, 4, 5, 6, 7, 8. About 80 zeros. So 6 zeros becomes million, about 400 million. Okay, so 20,000 is the answer. What it means is that whenever the company starts production, it should produce 20,000 units and then it should stop. That means 20,000 units divided by 4,000 becomes 5 weeks continuous production. And if we divide that into use, 20,000 divided by 2,000 becomes 10-week use. What I've done is explain in a graph here as well. On the first week, 4,000 are produced, but 2,000 are used. As the production is done, units are sold as well. So 2,000 will be left. 2,000 of the previous, on the second week, 4,000 more is made, so 4,000 will be made. And then 4,000 remaining, 4 more, 6,000 will be made. And then 8,000 will remain, and then 10,000 will remain. Even though 20,000 will be produced, but the maximum inventory level will be 10,000, because if we look at the production and minus the usage for the week of production, we will have maximum inventory, which in this case is 10,000. So 5 weeks on production, but the maximum inventory becomes 10,000, and then we will stop production and we will use from what is remaining, and when they become 0, then we will stop production. So we have 5 weeks on production, 5 weeks off production. So 5 weeks production cycle and 10 weeks usage cycle. Okay, the final thing I want to explain in this chapter, then we will move to the kit question, is something called free inventory, customer orders, and supplier orders. Free inventory is inventory available for sale. It doesn't mean it is free. It is inventory that can be sold. It is inventory that has not been sold to a supplier. Physical inventory is the actual inventory available in the warehouse. So free inventory can be higher or lower than physical inventory. If you go to a store and something is available there, it doesn't mean you can buy them. Maybe they have been already sold. Or maybe there is something on the way, even though something is not available in the shop, you can still buy it. On customer orders is inventory that has been sold but not yet taken by the customer. On supplier's order, inventory that we have bought but not yet delivered. So remember the free inventory formula. If you remember that, then other formulas are easy. So free inventory is physical inventory, the inventory that we have, minus what we have sold to our customers, plus what we have bought from supplier but not yet arrived, gives you free inventory. And then when they ask for anything else, you can rearrange this. For example, if they ask for physical inventory, you can bring these two to the other side. This becomes plus, this becomes minus, it will give you physical inventory. In this question, they are asking what is physical inventory. There are 27,500 units of part number X35 on order with the supplier and 16 to 50 units outstanding on existing customer orders. If the free inventory is 13,000, what is the physical inventory? Remember, physical inventory is free inventory, which is 13,000 plus on customers' orders, 16 to 50, minus suppliers' orders, which is 27,500, becomes 1750. So what I've done is I've put these figures in all of these formulas to prove that if 3 of them is given, you can find the third one. And then which of the following functions are fulfilled by goods received note? Remember, goods received note is a document that is used to confirm that the goods have been received. In goods received note and goods delivery notes, price is not important. The quantity and description of the goods is important. So provides information to update inventory records on receipt of goods, provides information to check the quantity on supplier's invoice, provides information to check the price on supplier's invoice. Remember, warehouse is not responsible for price, it is only responsible for quantity and quality. So only 1 and 2 would be the purpose of goods received note. So topic wise, it is enough small things that are there I will explain in the kit questions. So let's move to kit questions. Okay, let's look at kit questions. We already did this question. We did this one as well. This one as well. The annual demand for an item of inventory is 2500 units. The cost of placing an order is 80. And we already did this one as well. Which of the following is correct regard to inventory? Stockout arises when too little inventory is held. Safety inventory or level of units maintained in case there is unexpected demand. Safety inventory or buffer stock is inventory that is kept in separate location, not regularly used. It is kept for uncertainties to be used in unexpected situation. Obviously, buffer stock is there in warehouse all the time. So whenever we are calculating holding cost, we will not divide them by 2 because it is always there. A reorder level can be established by looking at maximum usage and maximum lead time. All of them is correct. What is the economic production run quantity, economic batch quantity used to establish? Reorder quantity, reorder level, order quantity, inventory level for production. Reorder quantity. What is the economic order quantity to nearest unit? Demand for product is 12,500 units for 3 months period. Each unit of product has a purchase price of 15 and ordering costs are 20 per order. Annual holding costs of 1 unit of product is 10% of purchase price. So the only complication here is that holding cost is not given, but it is 10% of the purchase price. So it becomes purchase price is 15. And then other than that, it is 2 multiplied by cost of ordering, 20 multiplied by demand. And remember, demand is for 3 months. This is another complication. We need to convert it to year, which will be multiplying by 4. 50,000. So in economic order quantity, everything has to be in years other than the ordering cost. But in economic batch quantity, they don't have to be in years. They just have to be consistent. So if I put it in calculator, two multiplied by 20 order cost multiplied by 50,000 divided by 1.50. Let's do it separately. It always creates complications. 2 multiplied by 20 ordering cost multiplied by 50,000 becomes about 2 million divided by 1.50 becomes 1.3 million. It becomes 1155. So D. What would be the effect on EOQ and total annual holding cost of decrease in the cost of ordering a batch of raw material? A company determines its ordering quantity for new raw material by using economic order quantity EOQ model. What would be the effect on EOQ and the total holding cost of a decrease in the cost of ordering a batch? If cost of ordering decreases, what happens? If cost of ordering decreases, you place many orders, because let's say you were buying material and the supplier was in a very distant location. So what would you do? You would buy many quantities at a time and you will place less orders because it is very difficult to deliver it from supplier. But if that supplier becomes near, what happens is you order less quantity and you order many times. So when the cost of ordering reduces, you order less quantities, and because of which holding cost reduces. So ordering quantity and holding cost both become lower. So D would be the answer. What is the reorder level in units which avoids stockout? So reorder level, remember, is maximum unit into maximum time, which in this case is 520 multiplied by 15, 7,800. They didn't ask for maximum level, but maximum level would be reorder level minus minimum usage into minimum time plus the new order coming 8,000 would be 14,000. And if they ask for minimum level, they haven't asked, it would be average. Let's find average. 10 plus 15 divided by 2 becomes 12.5 average. 12.5 multiplied by average usage is 400. It would be 2,800. Next, there's a double entry about material. My recommendation, there's nothing complicated about it, but my recommendation is look at it after process costing. So for now, just skip it. What is the annual cost of holding inventory of the component? A manufacturing company uses 25,000 components at an even rate during a year. Each order placed with the supplier of the component is for 2,000 components, which is economic order quantity. The company holds a buffer inventory of 500 units. The annual holding cost of one component inventory is 20. So remember, to find holding cost, we take average order quantity divided by 2 multiplied by ordering cost, which is 2 would be 2,000. But in this question, we have buffer stock. Buffer stock is 500. Buffer stock will always be in inventory, so it doesn't have to be divided by 2. So our average inventory would be 1,500 multiplied by 2, so 3,000 would be the cost of holding. What is the economic order quantity to nearest whole units? So I've already done this. For a particular component, the reorder quantity is 6,000 and the average inventory holding is 3,400. Using the drop-down list, select the level of safety inventory in whole units. It is exactly this question, but they're asking for safety inventory. If I take this question and I put a question mark here, yeah, the order quantity is given, which is 6,000. The average inventory is also given, which is 3,400. So 3,400 here as well. So I don't need to find the cost. Now using this, I can find the average inventory. I just have to take 6,000 divided by 2, which will give me 3,000. If I take 3,400 minus 3,000 from it, I have 3,000 minus 3,000 becomes 400. 400 is buffer stock. Let's prove it. 400 plus 6,000 divided by 2 equals 3,400. What is the economic order quantity? I will leave this one. What is the maximum level? I've already done enough questions about it, so I will leave it. Economic production run. ABC Co. gradually uses its resupply of inventory for at a rate of 10,000 units a week. Other information is available as follows. Weekly demand 5,000, setup cost of each production run 125, weekly cost of holding 1 unit 0.001. What is the economic production run? So it is 2 multiplied by cost of ordering, which is in this case the setup cost, multiplied by demand, 5,000 divided by holding cost, which is 0.001, 0.0025, multiplied by 1 minus rate of production, demand divided by rate of production, which is 5,000 divided by 10,000. So obviously I'm not putting it in calculator like this, so I would not worry about brackets. So 2 multiplied by 125 multiply by 50,000, 5,000 is 1.2 million something. Next, I will start from here. 5,000 divided by 10,000 gives me half, and minus that from 1 gives me half as well, and then 0.0025 multiplied by half becomes 0.00125. So I'll put it like this in calculator. 125,1234 divided by 0.00125. 31623. So the economic production or units that we produce at a time would be 31,623. Next, where on the graph would you read off the value of economic order quantity? Okay, so this is the graph of economic order quantity. The idea is when our quantity that we order is lower, the ordering cost would be higher. The holding cost would be lower because we are ordering less quantity, but we will have highest ordering cost. Now, when quantity that we order increases, which means we order more units, the more and more units we order, holding cost increases, but ordering cost reduces. The reduction in ordering cost is more than the increase in holding cost. So ordering cost, that's why there is a curve. Ordering cost reduces by more proportion than the increase in holding cost. There will be a point where they cross each other, after which the decrease in holding cost will be lower than the increase in holding cost. So this is where they cross. So in units, because we are looking at quantity line, in units it will be here. And this B is the holding cost and ordering cost at EOQ, and D is the total cost of holding and ordering. So EOQ, economic order quantity, would be C. This crossing of both is the holding cost and ordering cost. So the answer here is C. So remember I explained, I said I will explain in the graph. So that is why whenever you calculate EOQ, the holding cost and ordering costs are equal, because it finds that point. Okay, we already did this one. This one relates to FIFO and LIFO questions. So if you're coming to F2 from F3, you should already know this. Otherwise, this is it for this chapter.